Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg. And we go ahead with the global financial updates. The market participants are in a tug of war situation. There's a set of participants with a view that the hot labor market, high wage inflation, and a good number of openings is keeping the inflation higher. On the other side, the banking concerns and a slowing lending acts as a hurdle for growth, and the stuck between these two is the interest rates and the investors' confidence. Even the macro indicators like the wholesale inventory to the sales ratio are near the great financial crisis levels. Now, this is something of a concern for the economic growth. But having said that, the domestic performance have been good looking at the kind of PMI numbers, GST collection, as well as the auto sales we've been observing. So, PR, what should we make out of this? A strong domestic economy, but a divided global. What's your take?
Thanks, Nikhil. Coming directly to the question, I think India is expected to do well because of its its local demand of goods and services. Uh, I think this round, our systems have been uh, basically have been strengthened by a few incentive schemes and few support from a government. And RBI has done its it's basically a work very well in basically keep building the buffers at the time of a good at the good times, and which will be probably used again, so if required. So just to put it across, last year RBI spent $100 billion of our reserves to defend our currency. At the same point of time, they've already built closer to $57-58 billion again. So this is what RBI has done, and probably that will give some kind of a support to our economy. Coming back to the what happened yesterday, market was basically in US market equity indices were very quiet because all of important inflation numbers are likely to print today in US and Europe. In US, the numbers are expected to be printing. Headline numbers is printing forecasted to print at 5%, whereas the core, which excludes food and energy prices, is expected to rise 5.5% compared to 5.6% recorded in month of March. If you look at the month-on-month numbers is expected to be higher. It is expected to be 0.4%, vis-a-vis 0.1% in March. Today, German CPI also expected to be printed, and it's expected to be printed as 7.2% YoY. What we are seeing now in last week of April or second last week of April, what we were observing is that basically US Treasury yields, 1 month Treasury yields are dealing around 330, 340, and 350, which now since the debt ceiling limit is nearby, the 1 month T-bill yields moved up to 570 now. It had moved up by 24 basis points yesterday itself. Yield on 2 month T-bills also moved higher to 5.28%. Now, this is what happening where people are expecting that even the debt ceiling talks and conversation will be extended, there could be some hiccups. And experts feel that this could be the most continuous debt ceiling fight yet, and we can expect heightened market volatility in face of this uncertainty. Now, coming to the Fed members, Fed Williams, the New York Fed president, made some non-committable balanced remarks yesterday. Is saying that we have made an incredible progress on policy, on monetary policy, but not really committed that they have done raising rates. His statement was usual that future actions would be data dependent and rates will be raised if needed. And he's not expecting recession, but definitely he's expecting a tighter credit market, which can lead into how far Fed can go with the rate hikes. If we look at the how market is expecting June meeting before a CPI data, market is only expecting or pricing a 16% probability of rate hike of 25 basis in June, where the 84% probability is that there won't be any change in the Fed rates in the month of June. There was nothing much of a data yesterday, except there was a Chinese trade data, and that posted a very healthy trade surplus. It had posted a trade surplus of $90 billion against the expectations of $71.6 billion. This could have cheered up the market, but people have seen this surplus, trade surplus, is very, very bad number, because what happened is they saw that the export is only rising by 8.5%, whereas the import falling by 7.9%, and that basically means that neither global markets are growing and not Chinese market. The inbound shipments are really showing a very sharp slowdown in economic activity. Why I'm saying export numbers are rising by 8.5% is bad, because previous month it has grown by 14.8%, and previous baseline numbers were a very, very low number. This sharp deterioration in trade flows only renewing worries about the state of external demand and is close to the domestic economy. And this all led into a sharp correction in Hong Kong and Chinese stock indices. Coming back to the currencies were thinly traded and narrowly traded, where the Euro basically moved through 1.0980 support, but currently is dealing at 1.0, around same levels, where the GBP held on ahead of a Bank of England rate announcement, which is expected to be, there should be a hiking 25 basis point. Market is pricing 100% probability of a 25 basis point. We saw some kind of a move in rupee yesterday, dollar rupee. Dollar rupee has basically moved higher than 81.95. On break of 81.95, lots of traders and importers, traders cut their position and importers bought dollars for hedging their near-term payables. RBI is expected to be intervening around 80 to 20 today. Today's range we can expect in between of 81.95 to 82.20. That's all from me. Thanks a lot.
Okay, PR, that was really good. And yes, folks, even though the majors were thinly traded, we saw some bit of an action coming in for USD INR, with the INR depreciating against the dollar to some extent after seeing a long period of narrower range. But having said that, I really like to emphasize on the point wherein Pankaj mentioned that our domestic systems have been really strong with the incentives and structures coming in to place, and even a very active central bank. And for that matter, even a stress test carried out by the central bank on the PSUs came out with no major concerns, which states the domestic banking sector continues to stay strong comparatively. On the other side, US inflation numbers are to be expected today, and as Pankaj mentioned, there can be some moderation in the core CPI, but the month-on-month numbers can stay higher. And a contentious debt ceiling negotiation or a fight has kept the yields in the shorter term rising. So it's something which the market participants are still watching out for, and actions are to be observed. But the markets are still pricing in 84% probability of a pause by the FOMC in the next meeting. So that's a good observation that the market participants are already pricing in a pause on a larger extent. But is there a pause by the Bank of England tomorrow? Unlikely, with the double-digit inflation and a slowing growth. The Bank of England is expected to hike the rates by 25 basis points tomorrow. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.